Right, we should be live. A little bit of technical challenge there. Doing a slightly different setup today, but everything should be working. Let's wait for the stream to catch up, and that looks like it's working. Perfect. All right, welcome everybody. It is Tuesday at 6 p.m. At least where I live, that means it is time for office hours. So, I'm your host, Neil. I'm flying by myself today because we're doing something a little bit different than we usually do. So normally this is office hours Q&A where I have one of my people, Serena. She's on here with me and she's asking me questions that have come in over the last week or so from clients and people just emailing in or in our private groups or whatever. We get lots of questions all the time. So uh, I got two questions this week directly from a guy I was talking to, one of my local groups, and another from an investment forum that I was on. So these two questions are one is short and the other is long. So I figured I would take the time here to answer them and you know have them so that they are here and in a recorded format so we can refer back to them later. One of the great things about this whole thing, doing the Q&A, is that if we hit a question, I can just refer people back. Hey, we talked about that back here, and then my people chop up the videos and create individual files and all that jazz. So we're building a library as we go, which is pretty handy actually. So let's jump into it. So let's make sure I'm sharing the right thing. There we go. So this is Office Hours Q&A. We are Tax Sherpa. I am Neil, founder and chief tax strategist at Tax Sherpa. And we'll talk a little bit about me, but mostly this is about everybody else. So basically, I realized early on that the corporate life was not for me. And I've got a whole story about how that happened. I can tell you the exact moment I realized that, the past 20 years of schooling, it's like, yeah, that's all out the window. And then, have you ever gotten a nasty letter from the IRS? Well, I have. And it said I owed them over $1.3 million. And that was in 2007. Like most people, I ignored those letters because I was just like, I would see the number on the piece of paper and say, there's no way. Kind of toss it off to the side and stick my head in the sand. 70% of IRS notices get no response whatsoever. And to a certain degree, I think they rely on that. But so I ignored it for 2 years. And then after 2 years, they started garnishing my paycheck. And I was like, I got to fix this. So in 2009, I started fixing my own problem. And I did fix it. It took about a year. But then in that process, I got into the Wall Street tax planning world with my mentor. And since then, have over the last 15 years worked on over 50,000 tax returns on billions of dollars worth of client revenue and saving people tens of millions of dollars a year, which is great. And then in 2019, and really getting started in 2020, I founded Tax Sherpa, and the mission there is to help my tribe. And my tribe is the people like me, the people who either can't or won't get a job. And they're either solopreneurs, independent contractors, or small business people. And I want to help them get their quality of life back. And how do we do that? Well, depends on what you ask. So I love this quote: "The quality of our questions determines the quality of our life." And so my question is, what is the root problem with overpaying on your taxes? Because you can; it's optional, to be honest. You don't have to set yourself up in the lowest tax way. You can pay more, even if you pay whatever you calculate you owe. You can actually pay extra. You can go to the U.S. Treasury and donate towards the national debt. Totally optional. Nobody does it. I think last year, last time I looked at it, it was like $113,000 amongst all Americans had been paid using that program. But the real problem with doing that is that you're wasting 74 days of your life, and that's an average. Basically, if you take from a 35% tax rate to a 15% tax rate, that's factoring in everything. That's factoring in federal income tax, state income tax, the payroll tax and or self-employment tax, the additional Medicare tax, and on and on and on. When you take that rate from 35 to 15, that's saving 20%. of your income, right? So if you go to work and you work a day and you do whatever it is you do, and you come home and you take that money and you hand it over to the government, what did you actually do that day? And I, you can label it different ways, but for sure, you did not work for yourself. You did not work for your family. You did not work for your community. You didn't do anything to benefit you or the people around you. So to me, that's a waste. I want every, I want everybody in America, really, and we're going to get into that a little bit more today. But I want everybody in America to pay as little as possible, and ideally, that number is zero. And there are ways to do that depending on your situation. But everybody can be paying less. And so, by turning those days over to working for the government instead of yourself, you're wasting your life, as far as I'm concerned. So I want everybody to live their best lives possible, and that means doing all the things needed in order to reduce their taxes as much as possible. And whatever you do with that savings, those extra days, those extra dollars, most of my people are going to be reinvesting in their business because that's just how we're wired. We're mostly workaholics, and we, always want to grow and do better and do more. But some people just want to take a vacation. Some people want to go to their kid's soccer game. Some people want to go to Vegas. Whatever it is you choose to do, that's still a better result because it's your choice, and that's really, really important to me. So, at the same time, we get to defund the government. So there's that. that's a bonus. So this is the part where I talk about how I have the answers to all tax questions, and I do. The answer is it depends. It depends on facts and circumstances, and both questions tonight heavily depend on facts and circumstances. So let's get into it. So the first question I had was, this is a guy I met in one of my local networking groups, and he said that he had gotten a settlement, and they had asked him for his W-9, which is the form where you fill in your tax information. So, I'm Joe Schmo, my social security number is this, my address is that, And usually that is a precursor to getting a 1099. So W-9, 1099. That's how they match up. And he was asking why that was. And so I explained to him that settlements most of the time are not taxable because most of the time settlements come from a restitution, a reimbursement of a loss. So if you're in a car accident and you receive money, then that is not income. That is not new money coming into you. That is making you whole from a loss that you suffered. And so it's a reimbursement, essentially. And most settlements fall under that category. There are a couple that don't. So in a divorce settlement, you may have actual taxable income, potentially. That has been modified a bit since the Tax Cut and Jobs Act, but, still could be. Also, if you have a settlement that is from a claim related to income. So let's say you quit a job and they didn't give you your last paycheck. You sue and then it goes to court to get settled. Then that is taxable income because it is what you're getting back is actually the lost income that you had that you never received in the first place. So in those kind of situations, those do become taxable. And how those shake out can vary. I've seen several different settlements over the years that were taxable in various ways. I've seen some that were partially reimbursement and partially taxable. So if there was a class action lawsuit against, can't remember which one it was one of the pizza companies, one of the large national chains, and people got a back wages, they weren't counting overtime or something. I forget what the actual issue was, but they got some back wages and they got some some penalty stuff that wasn't taxable. So it depends, but for the most part, for most settlements that most people deal with, they're usually coming from an accident or something like that, and those are not taxable. I was actually looking at Schedule 1 here, and so Schedule 1 is an attachment to Form 1040. So one of Trump's ideas was that the 1040 should be fit on a postcard, and then so what they did was they took all the stuff that used to be on Form 1040 and they just attached schedules, and they just shifted the the language off onto other forums, which I guess works, sort of. But the 1040 is back to 2 full pages now. So yeah. Anyway, there is a special line item here where um, this is under Schedule 1, Part 2, which is adjustments to income, line 24, other adjustments, subparagraph I, attorney fees and court costs you paid in connection with an award from the IRS for information you provided that helped the IRS detect tax law violations. So what this is whistleblower money. So if you are a whistleblower for the IRS and the IRS collects a big chunk of tax, you get a percentage. So this is usually applied to corporations that have tax fraud schemes and things like that. And there have been some sizable awards in the past, and they're saying that is taxable income, but the fees that you pay to your attorney and everything, you get your special line on Schedule 1, so you can deduct those fees. So you're not taxed on money that you then had to pay out. So you're only getting taxed on the net, which is great. But I thought it was funny. They carved out a special line just for that. But yeah, so settlements usually not taxable unless it's related to actual income, and then that is taxable. So that's the basic difference. And there's a corollary to that on expenses. So people ask all the time, it's like, well, can I deduct legal expenses? And the answer is it depends. And what it depends on is if it is legal expenses in the pursuit of income, or if it's legal expenses not in pursuit of income. So your divorce attorney, not legal expense. Your attorney who is prepping up trademark paperwork is deductible because you're getting a trademark in order to create a brand, in order to sell to the public, in order to create income. So it all depends on what it's actually for. Income taxes, income tax deductions, income tax, income is all about the pursuit of income. That's really what defines a business, honestly, is the pursuit of income. You don't have to make money, but you have to try. So plenty of companies, most companies actually don't make money. And that actually is going to play into our second question of the night. So this question, I was on a forum. It was Mark Moss's 4-pillar blueprint community, and somebody had DM'd me and said, "Hey, I saw you were a tax guy. Had a question about, if you're just getting started, then how do I write stuff off?" And just kind of basic questions like that. And so here's the thing. Especially since the Tax Cut and Jobs Act, the write-offs for an individual working a day job are minimal, and that's unfortunate. So the write-offs kind of come in two flavors. So one are Schedule 1, Part 2 deductions. So all these adjustments to income, these are all deductions. So educator expenses. If you're a teacher, you can deduct a few $100 towards, like, if you buy supplies and decorations and stuff for your classroom. If you are a reservist or performing artist, you can have certain business expenses, the 2106. So this was one of the big changes for the Tax Cut and Jobs Act. 2106, which is unreimbursed expenses, used to apply to everybody. And then in 2017, that went away for everybody except for reservists and performing artists and fee-basis government officials. So in the old days, if you were like, this happened a lot with salespeople. So salespeople had enormous expenses that they would have to come out of pocket for their jobs. They could be taking clients out to lunch on their own dime. They could be using their personal car to drive all around town. We've had clients who were, distributors. So they would, and this was back when I was living and working in Florida. So we would have liquor distributors. They would drive all over the state and put like 47,000 miles on their car each year, which is just crazy. Had to go through a new car every 2 years, and that was their personal car, and they were paying for that out of their personal money, and so that's an unreimbursed employee expense. And then 2017 rolls around, Tax Cut and Jobs Act passed, gone, all of it. In fact, I remember the first year afterwards, I was sitting down with somebody. This is back when we were in person, before the vid, and we're going through the guy's information, W-2, yada yada yada, and we're wrapping up. And he says, "Oh, you didn't ask me about my job stuff." I was like, "Yeah, that's all done. Doesn't matter. If you work from home for your day job, doesn't matter. Used to matter. Doesn't anymore. Uh, so uh, so especially since the Tax Cut and Jobs Act, a lot of these deductions on the individual side as a wage earner have been eliminated. That's just one example. Yeah, and there's other things you can contribute to a health savings account. It's a few $1,000. I think it's 7,000 or 7,500 this year. Um, Moving expenses used to apply to everybody as long as you moved at least 50 miles and as long as you moved for income for a job. That used to be deductible. No longer unless you're in the armed forces. Self-employment tax, SEP contributions, simple contributions, all that. Self-employed health insurance deductions. Those only apply if you're self-employed, so not for day job people. Penalty for early withdrawal of savings. That's sort of deduction against interest income. Like if you have a CD and you pull it early and they charge you fees, that kind of thing. Alimony paid. This is a fun one. So before Tax Cut and Jobs Act, if you paid alimony, then it was a deduction to the payer and it was income to the payee. After Tax Cut and Jobs Act, you got divorced. Alimony payments are not deductible and not income. So it changed the math. But for the old plans, it still applies. So if you have an old divorce, although at this point it's becoming rarer and rarer because a lot of alimony plans are, for 10 years or less. The permanent alimony is pretty rare these days. So we don't see too many of those. IRA deductions, that certainly works, assuming you qualify and you make a traditional IRA contribution, $7,500 potentially. A student loan interest deduction, those are obviously coming back. We were on hold for a couple of years there, but the limits on this are typically low, and as you make more income, those deductions get eliminated, which is super fun. All this other stuff doesn't happen very much, so I'm not going to get into it. But those are all kind of the basics as far as deductions you get for if you have a day job. W-2 kind of income for W-2 for a business you don't own. That's the key part. So if you're working for somebody else, those are the things. If you're 1099 for a business you don't own, then you are your own business, and it's a whole different situation than what we're talking about tonight. But this is for people who get W-2s who work for a company that they don't own. Okay, so if you read the tax books about like, oh, here's 51 strategies to lower your taxes. This is the kind of stuff that they're talking about. They also talk about Schedule A. So Schedule A is your itemized deductions. Again, another big change with the Tax Cut and Jobs Act. So in the old system, before Tax Cut and Jobs Act, we had two things. We had an exemption based on the number of people in your tax household. So how many people are on your tax return? So it'd be like $4,000 times 3, and you had your standard / itemized deductions. Post Tax Cut and Jobs Act, so exemptions are gone. We only have standard versus itemized, and the standard is now larger. So for 2024, for a married filing joint couple, your standard deduction is 29,200, I believe. And so all this stuff, and this stuff is now less qualifying than it used to be. All this stuff has to add up to more than $29,000 before it starts to impact your tax return at all. So there's a couple of basic categories. Medical and dental expenses, those, you add up all those, and that's going to include out-of-pocket premiums. That's going to include out-of-pocket medical expenses, prescriptions, dental stuff, all kinds of things, physical therapy, all that jazz. You add up all that, and then you compare that to your adjusted gross income for the year, and the amount above 7.5% of your AGI, your adjusted gross income, is what gets included here. So let's say you make $100,000. Your AGI is, let's just say for simplicity, is also $100,000. Then it's only the medical expenses above $7,500 that begin to get entered here. So if you have $10,000 worth of medical expenses, that's going to be $2,500 that applies to Schedule A. All right. Taxes you pay. This is state and local. So this is your state income taxes or your state sales taxes for the states that don't have income taxes. And it's going to be your real estate taxes. It's going to be tag fees on your cars, things like that. So one of the huge changes was that this used to be, full freight, meaning that if you were a high income earner, you had a high W-2 in a high tax state, that that state income tax could be enormous. I've seen $70,000 of state tax pays, and under the Tax Cut and Jobs Act regime that we're in now, then that whole category is limited to 10,000. Doesn't matter if you paid 70, doesn't matter if you paid 30, doesn't matter if you paid 2. The limit is 10. 5 if you're married, filing separate. So most people hit that $10,000 limit pretty quick. And when you compare 10,000 to 29,000, now it's like, okay, well, we got to make 19,000 somewhere else before these things start to matter. Interest you pay, this is basically home mortgage interest. That's the primary thing. There's also investment interest, but we don't see too much of that. People who trade a lot on margin will incur that kind of stuff. Gifts to charity. We'll come back to gifts to charity, but basically, cash you give to charitable organizations. And then other than by cash or check means stuff. So if you donate, property, car, you donate furniture, if you donate clothing, all that kind of stuff goes there. And then casualty and theft losses. So this was another big change. Under the old rules, prior to Tax Cut and Jobs Act, this was casualty and theft losses for anything. So if a pipe breaks in your house and everything gets ruined, insurance doesn't cover anything, you're out of pocket 20 grand, that is a casualty and theft loss. If something was stolen, it's a theft loss. So under the Tax Cut and Jobs Act, the losses only count if you are also in a federally declared disaster area. And usually that's going to be like, fires and storms and things like that. And not just a fire in your house, but like a forest fire that wipes out half of California, that kind of fire. So so that was an oddly painful change to make. But they did these things. They imposed these limits to accomplish two things at once. So the first was, they had to quote unquote pay for the tax cuts on the other side, which was the business side. And whenever a bill is passed, the Congressional Budget Office prepares a 10-year report to say, okay, if these changes are implemented, this is going to be the financial impact. Those reports are 100% wrong, but they at least give like an idea directionally. Is this going to make the budget worse or better, right? So when they passed the Tax Cut and Jobs Act, they passed a lot of tax cuts mostly on the business side, and to quote unquote pay for the tax cuts, they had to increase taxes on other places. So they got rid of all these deductions for individuals. This is one of those cases. And then other itemized deductions, not much goes in here anymore. This is where 2106 expenses used to go, but are no longer there. Basically, the most common thing we see here is gambling losses. So if you have gambling income, then you can add gambling losses to your itemized deductions, but only up to the amount you win. So if you go to the slots and you win $5,000, you can put 5,000 on this line here, even if you lost 7,000. So you can only deduct up to the amount you win. And whether that works out or not depends on how many other itemized deductions you have. So if you had a huge mortgage and you were paying tons of interest and you were already into the itemized deductions range because you're exceeding your standard deduction, then the gambling losses will help you. But if you're underneath the standard deduction, if you have none of these, let's say you don't own your house, so you don't have any local taxes and you live in Florida, so there's no state income tax, and you don't have much medical, you're young and healthy people, let's say, and all these things are zero, then if you had $5,000 worth of gambling losses, you can put 5,000 there, but you're still underneath the standard, so it doesn't matter. It doesn't affect your calculations. And so you end up paying tax on that gambling income, even though you lost it. So those are just little nuances to be aware of. So when you go through those books you find in the business section of the bookstore or Amazon or whatever, they talk about all these different tax deductions. This is usually the kind of stuff they're talking about, how you can maximize these different things. And that's fine. I mean, I'm not opposed to funding an HSA. I'm not opposed to funding an IRA. I'm not opposed to student loan interest deductions. Yeah, do all those. But those are all just small. It's basically it. This is not what people are talking about when they want to find like real tax savings. It's like I want like 5 grand in my pocket. That's what we're talking about. So how do you do that? And there's a couple different ways. And fundamentally, they do involve Schedule 1, well, let's just look at the 1040 for a second. So this is the income section, right? So line 1A, amount from W-2. So this is your main day job income. These other things don't get, at least in our practice, we don't see very much. But yeah, this is just active income. Then you have interest, you have dividends, IRA, distributions, pensions and annuities, Social Security benefits. I had a video a couple weeks ago on Trump wants to make Social Security benefits not taxable, and people were all up in arms saying it's going to cost $1.5 trillion, which is nonsense. It'll cost 500 billion, so half a trillion, but it will not cost 1. So, so the key to the whole thing is, well, two parts. So one is the adjusted gross income gets calculated here. Your standard or itemized deduction goes there. And then we get qualified business income deductions, which obviously is not going to apply if you are working for somebody else. And then your taxable income goes here, line 15. Okay, so based on your taxable income and based on what kind of filing status you have, whether you're single, married, filing jointly, separately, head of household, qualifying survivor spouse, which is basically married, filing joint, then you get a tax assessed right there. And then from there, we start applying credits. So important thing to understand, there's deductions and then there's credits. A deduction is a subtraction from your income before the tax is calculated. A credit is a reduction of tax directly. So it doesn't affect your income. It's just after the tax is calculated, then we're going to reduce the tax. So like the child tax credit is a credit because it reduces your tax just 1 for 1. A deduction, let's say you have a $10,000 deduction of whatever, then that's going to reduce your income by 10,000, and the tax savings associated with that is going to be what would have the tax been on that $10,000, which is going to be related to your tax bracket. So if you're in the 32% bracket, you save 10 grand on your income, that's $3,200 in your pocket. So difference between deduction and credit. So we go through all that analysis, and it's like, well, how do we affect these numbers? So, well, one is we can create deductions, and the second is we can create credits. So people talk all the time, it's like, oh, if you have kids, you get great tax deductions. Well, actually, you get tax credits. You don't get any deductions for kids. However, I tell people constantly, yes, you do get tax credits for kids. No, it does not pay for having the kid. so they're not going to don't have kids for the tax purposes. Does not work out. But hey, kids are great. Have more of them if you want. And if they're there, we'll take advantage of them for sure. All right. So there are ways to get tax credits that are not on this list here. So the most popular one that people talk about is the electric vehicle credit, and this is worth up to $7,500, and depends on what model you buy and all that kind of stuff. But yeah, it works. That is a non-refundable credit, which means that let's say you get the full $7,500. Actually, we have a client that was looking at this. He came to us and says, "Hey, I think so." He already filed his 2023. He says, "I think the person I filed with missed the electric vehicle," and so we look at the tax returns. Like, sure enough, there's no electric vehicle credit on here. And he like at this line here, at line 24, he had 5,388, if I remember correctly. So the tax credit's worth 7,500, but it's non-refundable, meaning that it's only gonna reduce your tax to zero. It's never gonna give you cash back beyond that. So if he's got a $7,500 non-refundable credit and he still has a 5,388 tax liability, then his tax credit is 5,388, and that's it. And he won't be able to get any extra between the 5,388 and the 7,500. So that's one tax credit. Another tax credit is on renewable energy stuff. So solar installations, if you do geothermal on your house and that kind of stuff, you can get up to 30% tax credit. Also non-refundable. So we had a client years ago who came to us, didn't consult us throughout the year, but came to us, after the year then and says, "Hey, I bought this solar thing for $20,000. So, the sales guy told me I'm getting $6,000 on my taxes." And we're like, bad news for you. You should have called us first because that was a sales pitch. You could get up to 6,000, but in your case, no, because we already have you in a low tax situation. You don't even owe $6,000. So I think he owed like 1,200 bucks or something. So you got to be careful with credits, making sure that they actually pay for themselves as advertised rather than falling for a sales pitch. Uh, so uh, the difference between those and refundable credits is refundable credits go under payments, meaning that the IRS is counting them as though you had paid in already that amount. So you get cash back. So the most common one is the earned income credit. Earned income credit is for low income families who have children primarily. And if you don't make enough, the government gives you an extra credit as though you had paid in money on your taxes. They'll give you a refund based on that. And there's a couple of things. American Opportunity Credit is for undergraduate college, additional child tax credit from Schedule 8812. That's there's different portions of the child tax credit. Some is refundable, some is not. That's currently an active area of debate in Congress. And there's others. In fact, the IRS just put out a notice on Friday, watching out for tax scams for fake credits. So the one we see, the fake credit we see the most often is the fuel tax credit. So if you ever see this on your tax return by somebody that has prepared a tax return for you, just run. Do not sign. Do not do anything. Just take your papers and go. The federal fuel tax credit is a credit for specific use of of fuel, like gasoline. Uh, so if you use it for like off-road, like farm equipment or charitable purposes, every time you buy a gallon of gas, there's taxes inside of that amount that you pay. You can get a refund on that if you use it for specific approved purposes, which is very rare, very rare. So like 90% of the people claiming this credit are doing so fraudulently, and do not do it. You will get in a whole world of trouble. Uh, so so watch out for that. And yeah, so that's my spiel on that. So it's been a whole lot of bad news so far, right? So here's where credits do come in. In If you are a high income wage earner and you got to be an accredited investor. There's different definitions for that. Whether you have a net worth over $1 million, excluding your house, you make at least 200. It's 200 grand a year for 2 years. I'd have to check, but something like that. So if you're an accredited investor, then the world of investments opens up to you significantly beyond other people who aren't accredited investors. Basically, the way the Securities and Exchange Act was written was that if you're rich, you are assumed to be knowledgeable and can protect yourself. If you are not rich, then we're going to protect you on your own behalf, even if you wanted this stuff. So the I need to go upstairs. There, it's trying to come in. Where was I? So if you're rich, then you still have access to these opportunities, and you can do things like you can buy certain types of credits from other businesses. And the types of credits are a wide variety. You can do things like you can buy into leveraged leveraged charities where you actually create a charitable deduction that's greater than the amount that you put in. And there's different structures for that. But basically, those are creating deductions and credits, and they're going to be sold to you. There's a whole secondary marketplace for this. They're going to be sold at a discount to whatever their tax impact is going to be. So if you are buying $100,000 worth of credits, it might be, depending on the deal, it might be $40,000, it might be $60,000, it might be $80,000, but you're still net positive because you get $100,000 worth of credit. The caveat with that, obviously, is you have to have enough tax owed in order for that to make sense, right? That's going to be the minority of people. So that rules out most people. On the charity side, same kind of thing. You got to have enough tax owed in order to create these massive deductions and have them pay for themselves. But if you're a high wage earner, then those are viable strategies, absolutely. But let's talk about everybody else. Let's talk about the 95%, I guess. So the real answer to saving money on taxes, if you are a day job owner, is Schedule 1, Part 1. And that's up here. This is the additional income section, which sounds confusing, right? So this is things that add to your debt. So like we talked about gambling. We talked about we didn't talk about cancellation of debt. So cancellation of debt, like when you take out a mortgage, this is the most common example. You take out a mortgage, and then when you receive that money for it to buy that house, that's not income because it's a loan. You got to pay it back. However, if you don't pay it back and they end up writing it off, then all that money becomes taxable income in that year, which we saw a lot of after the financial crisis of '08. And same thing with a credit card. If you default on a credit card and they write it off, you get a 1099-C, which is cancellation of debt income. So that's never good. If you get money from the Alaska Permanent Fund, that is taxable income. If you serve on jury duty and you make whatever it's $30 a day, that's taxable income. There's a whole bunch of different things that are taxable income. And so how does that create a deduction, right? Well, what if some of these numbers are negative? That is a way to create a tax deduction. So if we have negative income, that subtracts against your other income. So, these things get all totaled here to line 10. And then you go to Form 1040 here, and then those additional income lines get added on line 8. So if we have a negative number there, you're going to have your positive number of whatever your W-2 is, let's say 100 grand. And then you're going to have a negative number here on line 8. And then you're going to have your standard deduction based on your filing status. And so your taxable income is going to be W-2 minus whatever this is, minus, your standard deduction, 29.2 or 14.6 if you're single, whatever the number is. And that's going to give you your taxable income. Your tax gets assessed based on that number and your filing status, and then you go on from there. So that's the super short version of how to create tax deductions if you are a day job. And I'm going to show you 2 strategies to do that, and the 2 are real estate and side businesses. So let's talk about real estate here first. So on Schedule E, Schedule E. Schedule E. I should have had this up, but Schedule E, page 1 is supplemental income and loss primarily from real estate. And you could also have royalties if you have book sales or things like that. But primarily we use this for real estate. Now, here's the thing. Real estate gets complicated. Normally, real estate, and this is investment property. This is real estate you're renting out for income. Normally, real estate is limited. So, you'll have your rents received right here, and then you have all your expenses. So if you have to advertise, if you have commissions, you got to pay insurance, there's real estate taxes, you might need supplies or repairs. All these things are expenses against that rental income. Mortgages, the entire payment is not deductible. So the only part that is deductible is the interest. Also, taxes and insurance escrows are expenses, but the principal payment inside your mortgage, and most mortgages are amortizing, meaning that there's both principal and interest inside each payment. The principal portion is not a deduction because when you received that loan, you didn't pay income tax on it because it wasn't yours. It was a loan. And just like when you pay back that loan, it's not a deduction. So that's even Steven. So only the mortgage interest becomes a deduction. And then hopefully, if you bought right and you're renting in a well thought out portfolio, then you're going to have cash left over. So you're going to be cash flow positive. That's the goal. So what the number is depends on the property. Obviously, maybe it's $300 a month, maybe it's $10,000. Just depends on the property. Then we have depreciation. So depreciation is the write down or the write off of the accruing expense of replacing property. So if you buy a single family house, you bought, there's a house, but there's also land, right? The land does not depreciate. So you don't get to write off any of the land. The house, though, does depreciate. So I just put a new roof on my house. That cost me 20 grand. And that's an example of how things wear out, right? It's not just I bought a house one time and the end, right? There's constant things to do. So to reflect that, what the way the code is written is that for residential real estate, for domestic residential real estate, we have a 27.5-year lifetime, meaning that we write off roughly 4% of the structure cost each year. So let's say, we go through this whole thing for property A, and before we factor in depreciation, we're at positive $5,000, right? But the structure that we bought cost us $200,000. And so that's going to create an $8,000 depreciation deduction each year. That takes us from positive 5 to negative 3. And then that negative 3 gets, recorded down here and goes on to Schedule 1 on line 5, and that gets included down here, and that gets into line 8 of your 1040. So that's going to be a negative 3,000 flowing through right there. And so you have your W-2 income minus $3,000, lowers your AGI, lowers your taxable income, lowers your taxes. Make sense? I can't hear any of you, so I'm going to assume you're good. I'm also not watching the chat. But $3,000, if you're in the 24% bracket, that's $600. Yeah, I'll take the $600, but it's not exciting, right? So the question is, how do we do better, right? And the way to do better is to do what's called cost segregation. So cost segregation is, we take that same situation. We bought a piece of land, we bought a structure, and we're depreciating the structure. Cost segregation looks at the structure and says, okay, yes, the building itself is written off at 27.5 years, roughly 4% each year, but that building is not all one thing. There's all kinds of stuff in there, right? There's a driveway, there's landscaping, there's hardscaping, there's wiring, there's furniture, there's ceiling fans, there's flooring, there's, on and on. So you hire an engineering firm to generate a report for you that separates out all the different types of property inside that building. And also outside on the land, the hardscaping and things. And all of those have shorter depreciation lives, meaning that they get depreciated faster, meaning that the early years of acquiring that structure, your depreciation number is much, much higher. And depending on the structure, depending on the property, can be enormous in year one. Now, the rules on this change a little bit with these last couple of years as the bonus depreciation rules have gotten not as good. But we'll see how that all shakes out. But even with the current rules that are not as good as they were 2 years ago, still pretty good. So let's say we have that $200,000 structure. Oftentimes, we'll see a cost segregation report come back, and it will have that shorter term stuff, the hardscaping and the wiring, cabinetry, and all that. That will be 15% of the total. So now we're saying, instead of a $200,000 building, we have a $170,000 building and $30,000 of other stuff. And that $30,000 we can write off, let's call it 15 in year one. Okay. So now instead of a $3,000 loss on the real estate, we have like a $17,000 loss. There's a little bit of add backs that you have to do in to make that math work, but take my word for it, around $17,000. So now we have, instead of $3,000 or minus $3,000 here on line 8, we have minus $17,000 on line 8. And now we're doing better, right? Because if we were in the 27% bracket, instead of $600, now we're talking about $4,000 in our pockets of actual tax savings from doing that process. So now, starting to get a little bit more exciting. There are problems with that, though. So the problem is that rental real estate, by default, is passive. Okay? So passive means a couple things. Passive means that your passive losses, like we're talking about here, are limited. So the absolute limit is $25,000. So if you had 3 properties doing this and they each generated $17,000 loss, you get to deduct 25, and then the rest rolls forward. And it'll keep rolling forward until either you use it or until you sell a property. So that's problem number one. Problem number two is that the passive activity losses start to be reduced even from the 25,000 as you make more money. As you make above 100,000, those losses get scrunched down and down and down. And when you get to 150, they go to zero. And then all the losses will just continue to roll forward into the future until you can either use them or until you sell the property. And then if you sell a property, then your gain is less because you have these losses that have been building for years. Which is not the end of the world, but I'd rather have cash now rather than sometime in the future when I sell a property. So how do we get around that? There's two ways. Way number one is to have short-term rentals, because there's in the definition of rental property, if your average stay is under 7 days, then it is not considered a rental at all. It is actually because you're not renting property. That it's not the property itself that you are doing. You're actually in the hospitality business. It's a different thing. So now that becomes an active trade or business, and that becomes ordinary income, not passive income, and then gets that minus number gets to count against your day job income. Okay, so that's thing number one. However, the market for short-term rentals has been terrible this last year and a half. So I don't know if you want to buy one of those or not. Up to you. We don't give investment advice, but a lot of people have been unhappy. Although maybe things have dropped enough where it makes sense again. I don't know. But that's way number one. Way number two is material participation. So the IRS has 7 different tests for material participation, meaning that it's not just you as an owner. You're actually doing stuff actively in order to convert this from a passive investment to an active investment. And there are, like I said, there's 7 different tests, but there's 3 that really apply to most people. So one is the real estate professional test. So real estate professional means that you spend at least 750 hours a year and at least 50% of your time, which is hard to do with a day job, in real estate related activities. The advantage of this test is that it's the broadest because it allows you to incorporate other types of real estate activities. So like if you're a real estate agent who's a contractor, works for yourself, that counts. If you are a real estate developer, that counts. If you are a real estate manager, that counts, even though those are not directly related to this particular property that we're discussing. So that's real estate professional status. If you satisfy that, you're materially participating, you can use the losses against active income. Test number 2 is a 500-hour test. So this only counts on working on the property. And you can elect multiple properties. That's a subtlety, but let's just say on your own real estate portfolio, you're spending at least 500 hours a year. That counts as material. There's a lesser test that's 100 hours. However, the 100-hour test, you have to put in at least 100 hours, and you have to be the single person spending the most time, which is a weird thing, but so like if you have a handyman who's at your house 3 days during the year and puts in 50 hours, well, okay, so that won't work. But if they put in over the course of the year, if they work there 2 weeks, a couple days on January, a few days in March, just over the course of the year adds up to be, more than you, then you don't qualify for that test. So that's actually a hard test to qualify for. The 500-hour test is better because it doesn't have that restriction. But if you can demonstrate the 100 hours and you can attest that nobody else is working more than you on this property or these properties, then you satisfy for that, and that's material participation. And then how do you prove all that? Is you got to have logs, and we've got a template for keeping track of your hours throughout the year. If you want that, just email our office at taxsherpa.com. So whichever way, whether you're doing short-term rental or you're doing the material participation route, both of those convert the rental activity into active income or active losses. And then those losses count against your day job income, and those can generate tax savings. So that's the real estate side of things. And it can be super powerful because of the leverage built into real estate. So if you let's just say you buy a short-term rental. You buy a short-term rental for $500,000, just pick a number, but you only put in 10 grand because you got some special mortgage deal. Well, you get to play the depreciation games on the full 500,000, whatever that number turns out to be for that particular property. And so because of the leverage involved here, it can be super powerful in that in generating those tax losses. And you know, if you bought well and you planned well, then the income stream from the rents will pay for the the mortgage cost, and then you won't be out of pocket anything in order to create these tax savings. So it's a freebie. And if you do it really well, then you can use the tax savings that you generated from this property in order to use that as a down payment for the next property, do it all over again. So that's a little bit of an advanced technique, but it is viable. Um, I know I'm going long. I knew it was going to be a long thing. Maybe I'll just stream longer. I don't know. Uh, okay, so that's kind of the first two suites of um, of tax strategies for day jobs. So it's like, yeah, there's all the little deduction stuff, but then there's accredited investor opportunities for tax credits and deductions. That's kind of one set of things. I call those exotics because you can't just do them on your own. You gotta team up with other people. Um, Second set is real estate, active or material. Third one is side business. So this is, I think, long term, the most powerful strategy. May not be. It depends on the numbers, but may not be as strong as cost segregation and material participation in any given. But basically, you got to be your own boss. And in the beginning, especially, most businesses lose money. And we have a whole bunch of tax strategies on the business side. It's like, how can we generate necessary and ordinary deductions that are qualified for reducing your taxable income. And I'll just hit on this real quickly. But basically, you got to have a real company. You got to be doing a real thing. So many people just want to say, oh, I just want a tax strategies. Well, there's stuff you got to do. You have to, like I talked about earlier, you have to be in the pursuit of income. So I use this example all the time. Down the street from me, where my grocery store is, there's a little shopping center, and so there's the shopping center. It's kind of this weird L shape, and right next to the shopping center there's a one of the bays of the center, and places have come in and out of that particular bay a lot. And one day I went to the grocery store and I saw it was called Popcorn Mania or something like that. It's like, the frozen yogurt places where you go in and you pour your own and you put on your own toppings and you pay by weight. It was like that, but for popcorn. And so they had all these big, beautiful popcorn machines of all these different flavors. And I thought it was the weirdest concept for a store. And so they had all their interior, refit. They had all their equipment. They had all the point of sale systems. I don't know how much they spent. It was a lot. I don't know if it was a franchise or if it was a solo operator. They had the signage, whatever advertising they did. They're spending tons and tons of money. And I never saw a single person in there ever. And then 3 months later, they were gone. So are those expenses tax deductible? Yeah, they are. Because they were in the pursuit of income, even though they didn't make any, even though they lost their shirt. It still was in the pursuit. They were necessary and ordinary, and those qualify. So that creates tax losses. Similarly, if you set up a side business, which might be related to your day job, might be something totally different. I knew one girl, she was a lawyer, and she would go around at night and teach people how to cook in their own kitchens. Totally separate side job. But we went through the tax planning process on it, and created entities, separate bank accounts, do all the things. You have to have all the trappings of a business in order to have business deductions. If you're going to go this route, which honestly I think everybody should have an LLC, just kind of across the board. Everybody does something, and when I dig in with people, so many times I find that they're doing something on the side. It's like maybe 1 out of 10 or 1 out of 20 are just not, but most people are doing something. So it's like I've had guys who it's like, oh, I buy and sell sneakers. Okay, this was before sneakerheads became like a big cool thing. I've had people selling coral out of their garage. I've had people raising snakes in a spare bedroom. I've had the snakes thing always gets me. So there's just like these bins, like the little plastic slider bins, and they're just in the spare bedroom. Crazy stuff. Anyway, all kinds of all kinds of things happen. I had one guy, he was doing kind of like promotional materials, like if you need pens or jackets or stuff. That's just what he was interested in. And here's the thing, is that so many people start because they think it's like, oh, it'll be fun and it's a great tax write-off and blah, blah, blah. But then like something happens in your mind where you give yourself permission. And once that starts to happen, it's like, wow, income does start to come in because I'm more open to these possibilities. And so, whether you take, the view of like The Secret or more of a psycho-cybernetics kind of approach, if you're more spiritual, more rational, whatever, stuff happens when you allow yourself to do it. So I'm a big fan of having the side business when you have the day job, creating the tax deductions, doing all the things you need to do. And there are things you need to do in order to actually take these deductions legitimately. But it's a super powerful way to create tax deductions. And how much depends, right? Like I said before, it depends on facts and circumstances. Uh, but the big thing that the IRS checks for when it comes to side businesses, and I strongly recommend either partnership or S corp. Do not do this on a Schedule C because that's just asking for audits. But the things that they check on S corps partnerships is basis. Because in order to take a tax deduction from a company loss, you have to show that you have enough investment in the company in order to absorb that loss. So if and where this gets tricky is with debt. So if you have a company go into debt, that doesn't count for your basis in most cases. And so if it generates a loss from that tax debt, or sorry, it takes a loss from that debt on tax basis, and you don't have the personal basis in the company, then it doesn't matter what the loss on the company side is. You won't be able to take it as a write-off on your personal taxes. You got to follow the plan, and you got to establish basis, and that means investing enough from your personal funds into the business in order to absorb the loss the business creates. That's critical. And for all of our clients, obviously we coach everybody through that, but it is super, super important, and it's something the IRS looks more and more at. So be aware. But yeah, so let's say you have that same $100,000 W-2 and you have a $20,000 loss on your S corp, then your income is lower by $20,000. And again, if we're talking about 24% tax bracket, that's $4,800 in your pocket, $5,000. If we include state, and obviously our numbers are never even, all that kind of stuff. Very, very straightforward way to generate $5,000 worth of tax savings for you. So we're at the end of the hour. I hope that all at least opens your eyes up to the possibilities. These are the two most powerful ways to create tax savings on the individual side. If you have a day job, if you own your own business, there's way more to be done. But as a day job, you're much more limited. But these are two strategies that are super powerful and work across the board for everybody. The exotic stuff, charity and tax credits, you got to be making 250, sometimes 400 before those start to become available and financially make sense. But anybody can buy investment real estate. Anybody can start their own side business, and as long as you follow all the rules, then you're good. So that's the key. So what do we want to do at the end here? I did want to point you towards a new resource. I'm coming out with a it's related to the side business stuff. I'm coming out with a new course in the next couple of weeks that I'm calling tentatively the 74 Days course. So this is kind of getting you from step 0 to step 1. So I was like, oh, I have this idea of, I want to do whatever. I want to be a graphic designer. I want to sell Pokemon cards. I don't know. People still sell Pokemon cards? I don't know. I want to, raise snakes in my bedroom, whatever it is. It's like, then the question is, now what? And this course answers, now what? It'll step you through. Say, okay, I need an LLC. Do I have to have a special name? Do I have to be a PA or all that kind of stuff? Create bank accounts. How many bank accounts do I need? Which bank accounts do I need? How do I handle my cash flow? How do I set up my basic tax strategies? On and on. How do I do my bookkeeping? On and on. It's 8 different modules of, I think the total is like 30 videos and courses, and there's templates. It's a whole slew of things. So it's not ready yet, but you can sign up to be notified when it is ready at taxsherpa.com/74-days. And that will take you to, oh, just loaded up actually. Sherpa.com/74-days. And it's just you put in your name and email. That's it. There's no payment due or right now. When we are ready, we'll send you an email and you can get in on the launch price, which is just going to be $47. So if you want to start your own side business to help yourself defend against your day job income, then this will show you how to do that. And then 47 save $5,000. That math works. All right, so you just put in your name, put in your email, notify me when it's ready, and then I talked to my guy today, and he thinks we're going to have a final draft ready for review on Friday. No promises though, so might be a week, might be 3, but soon. It's I know I've recorded all my parts, and they're laying out all the text and the copy and everything, so we should be good to go fairly soon. Got it all the graphics. So if you're interested in that, go ahead and go to taxsherpa.com/74-days, 74-days, and you can get on the notification list, and we will see you then. But that is my time, and I wrapped that up fairly quickly. I kind of accelerated at the end there, but I hope that made sense to people. If you have any questions, email office@taxsherpa.com, and we'll get you sorted.